So, hey, welcome back to Accelerated Investor. Hey, this is Josh, and I'm really excited that you're joining me for this next episode. In this episode of AI, I am interviewing Adam Stern. Now, the reason why you want to listen to this episode is Adam has actually transacted more single-family rental portfolios than any other single professional broker in SFR history. Okay, did you hear that? In history, he's built a firm presence in the institutional single-family rental space. And over the past decade, he's made a career out of listing and selling existing rental portfolios to some of the largest institutional investors in real estate investing, including newly emerging private equity groups. Adam has over a decade of real estate investing experience and recently launched his newest company, which is called Strata SFR. And Strata SFR is focused on the build to rent community. He also was the president and founder of an online single family rental marketplace called Own America, which he sold back in 2019. So in this interview with Adam Stern, you're going to hear, number one, how Adam became the top broker in the history of the single family rental space. Number two, he's going to tell you why he believes in build to rent and why building properties and building communities, building developments to actually not sell them, but to rent them is the strategy of the future. And you're also going to hear some of Adam's top strategies for how he is able to create relationships with some of the top institutions that are buying residential real estate to rent, and how he's turned residential real estate into a commercial transaction. So I think you're going to love this interview on the AI podcast with Adam Stern.
Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you're looking to retire early with forever passive income, you're in the right place. This podcast is the go-to destination for real estate investors, both active and passive, and multifamily apartment investors, both new, intermediate, and advanced. Now, sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
So Adam, listen, so excited to have you on today on Accelerated Investor. Thanks for being here.
Good to be here, Josh. Thanks for having me.
Hey, you bet. So Adam, listen, when I got some information about you and your company, about Strata, and I started reading your bio, having been one of the most successful brokers in history that sold more rental portfolios than anybody, I'm like, got to have this guy on the show. So let's talk about what are you doing now? What are you doing right in the middle of COVID? COVID's kind of hopefully winding down, going away soon. But hopefully, what are you up to right now that you're excited about? What are you working on today? Brokering deals, selling single family, building portfolios. That's working well for you.
So what's not to be excited about the single family rental space? I don't know, for anyone that's been following what's happening in single family rental, everyone was really worried that COVID would give it a big hit, that it wouldn't really thrive the way it has over the last year in COVID. But the storyline is people are moving out of population centers. People need more room. People are, naturally, the millennial class is getting to the age where they start thinking about buying homes, and they're kind of out of apartments and not yet ready to buy a single family home. And single family rentals has really been a beneficiary of that. And we kind of got through a weird period at Q1, Q2 last year where everyone was a little bit weary about what was going to happen, whether new inventory was going to come on the market, whether prices were going to go down, prices were going to go up. What ended up happening was people ramped up buying in the single family rental space because institutional investors that had raised money to plow into the space, more of that money ended up coming in. Rental rates didn't go down, didn't stay the same, but they ended up ticking up in most major markets around the country because people had a dire need to, find more space, and the single family rental space has been a beneficiary of that. So I'm more or less a broker in the space, and I focus on helping institutional capital find its way into the space through the purchase of portfolios and also the purchase of built for rent projects. So I was on kind of eggshells for a couple quarters last year.
We all were.
When we realized the world was going to implode. And hey, new construction started going like gangbusters. All this money flowed into the space to buy new construction, build for rent projects, and SFR portfolios. Kind of like the anxiety lifted, and everyone felt a lot better about it. And for the last, call it 12 months, things have just been going at a million miles an hour in most markets around the country that have solid fundamentals, solid job growth, solid population shifts, and it's been really great. The COVID didn't hurt the SFR industry; it actually supercharged it for at least the last 12 months.
Absolutely, and the people who own a single family, for the most part, the retail mom pop that live there with their wife and husband, kids. They're not really selling, right? They're not. There's not a lot of those people moving, so there's so little inventory on the MLS. So prices keep going up, so much so that I'm actually selling, because we own so many apartments now. We're selling all of our SFR, getting on the market, all the 1 to 4 units, and every time we put something on the market, it's selling in like 72 hours or less for full price.
Yeah,
it's absolutely wild because there's no inventory to pick from.
It's crazy. And I know a big part of your audience are people that have a focus toward building wealth through real estate. And you think about what's happening in the single family rental space right now, like from a mom and pop investor standpoint, how do you ride the trend and how do you make money from what's happening right now? What I do is all well and good. I sell large swaths of properties to big institutions, but someone that owns 1 or 2 or just a handful of single family rentals might be thinking, yeah, that's great for them, but like, how does this affect me? And I think depending on your view of the market, you could do a few things if you're an individual investor. I mean, right now, there's very, very little inventory in most major markets around the country. Right. And if that's the case, your opportunity to exit your property, whether you own 1, 2, 5, is probably better now than ever. People are buying at lower cap rates, higher prices now than ever because there's so much capital in the space. So if you think it's a good time to exit, it is. The question is, where do you put your money? And I guess the big question is, if you sell your rental, are you going to put the money in the stock market? Yeah, maybe it's overheated right now. If you're really good at finding good deals, maybe you sell your property and then you look for the next good deal, even though it's harder to find. A lot of my clients are thinking that COVID will eventually wash out to have a number of foreclosures happen as a result. And you look at the mortgage delinquency numbers, and they've been relatively steady. I think a Lending Tree came out with a report that said 30 or 60-day delinquencies had ticked up a little bit. So I don't know if anyone's thinking there's going to be another meltdown or at the very least a big swath of foreclosures to hit the market. But whatever your strategy is, it's an easier time right now to exit an SFR portfolio or a handful of SFR. There's plenty of money to get it. The real question is, where do you put that money? Do you plow it back into real estate, or do you kind of find another asset class to put it in? And you're in multifamily, so you would know the opportunity to switch from single family to multifamily, or multifamily to another asset class like office or flex or industrial or something like that. I'm not an expert in those asset classes, so I don't have a really good answer for you.
Yeah, no doubt. I mean, if you're in a single family and looking to kind of level up, there's options to become a private limited partner in a syndication where let's say you make $100,000 on an SFR sale. Now you take that $100,000 of principal and invest it in a syndication where you're truly a limited partner and have no responsibility for day-to-day operation at all. You're just either waiting for that sale or refi event and probably getting a preferred return along the way. And then hopefully if it's a refi, you keep your equity in that deal, get your principal back and invest again somewhere else. So that's what I would do. That's what I am doing. And then obviously diversification, even though office is hurting, some retail is hurting because of COVID and because people leaving offices, working from home. One of the things that we're looking at is actually the cannabis space, because cannabis is now legal, either medicinal or recreational, in 39 different states. And some of those strip centers that are hurting, there's a lot of cannabis companies that are looking to put dispensaries in those places. So I'm not looking to get in the cannabis business. I'm in the real estate business of owning that piece of real estate, having the cannabis companies actually pay for the improvements on that strip center, and then doing a triple net lease, right? So there's always, I guess my point there is not, people doing what I do. Everyone can follow if they want to follow and do what we do, great. If they want to follow, do what you do, great. I guess my point is there's always opportunity, right? The market shifts. You've got to find, what's the next kind of thing that's coming? So Adam, I'm curious to hear from you about, you've sold more single family portfolios and properties than almost anybody in the industry. So it's not like you're just selling a couple hundred units here, five units there. Talking about hundreds, thousands of units to big institutions. So how did you get into the space, and when did you do your first large institutional portfolio transaction?
Yeah, so kind of my history in the space has been kind of I've been pushed into different sectors of the space, and it all kind of started in 2010 during the housing meltdown. I started a company with a partner called Own America. We ended up doing acquisitions through an agent network that we created all over the country, helping institutions buy SFR through the MLS, through our agent network. We turned that into a platform that helps mid-cap and small-cap portfolio owners, people that own SFR in 5, 10, 20, 100 group sets to those very same institutions. So I became a really specialized broker that only knew this asset class, only knew, like if you asked me to sell one house, I'd have no idea how to do it. But if you give me 100 houses, I'm your guy, right? So we built this platform up. We sold it back in 2019. All my clients that were mainly REITs and institutions and multifamily funds and private equity firms and family offices, they were all asking for the same thing. It had come to pass where it made more sense to build a new construction property and put a tenant in there than it did to buy an existing home in most markets. So there was this trend called build for rent. Everyone was really hot on it.
Love that.
And I said, all right, as a broker, how the hell do I add value? I can keep out there finding SFR portfolios, and I still do that. But I learned what everyone was looking for in the build for rent space, and I really focused my attention on finding and putting together build for rent deals. So in 2020, I basically, I parted ways with the company that bought my company, and it was great. It was a great split. Started Strat SFR to focus on SFR portfolios and build for rent. And more or less, what I do is I find where there is a common need on the capital side. So, out of 36 investors, 3/4 of them want to own in the Smile States, the Southeast, from Raleigh to Jacksonville to Tampa. They want to buy in solid demographic areas with good schools, close to transit, close to amenities. And, everyone has a nuanced view of what they're looking for, but there's a common thread that goes through all of them. So I'm like, all right, let me find the common thread and let me focus my attention on finding assets that fit the majority of those people. And that's what I've been doing. I've been finding build for rent projects, mostly townhomes and single family detached communities. And the idea behind build for rent, which, for people that don't know, is if you live in an apartment complex, it's usually highly amenitized and you live very close to other people. You don't have a backyard, you don't have a garage. And if you're not quite ready to move into a single family house because you don't have the down payment or your lifestyle is just, it doesn't correlate. Now there's an option to rent either a brand new construction unit in a entirely condensed community of all rentals, which feels like an apartment complex, but you have a garage and you have a backyard and you're living in a house versus an apartment complex. And that's the trend right now in SFR. So it's a big focus of mine, as well as the good old standby, which is, people like you and me and others that have amassed portfolios of, 10, 20, 40, 100. I'm working on a 250 property portfolio right now. Not a lot of brokers know how to deal with this asset class on the build for rent side and on the portfolio side. So I was lucky enough to kind of find my niche and just hammer it,
So Adam, take us through a recent build to rent community or development or deal that you've done. It could be 5 houses, could be 50 at 500. I don't care. But to walk us through a deal, I've never done a build for rent. So I'm curious to see who are the players, how do you find the land, how do you find the construction GC, the whole thing. And then how can our audience play in that space, being an active investor or a passive investor or some sort of JV partner? Yeah,
sure. So build for rent, there's a number of ways people can make money in build for rent, either by being a principal or a broker, or, there's a continuum of a lot of things that go on in a build for rent transaction. And I'll give you an example through a deal that I did. I had a builder that knew how to source land, bring it through the zoning process and bring it through the entitlement process. And he had 2 subdivisions. They're both townhomes. They were in submarkets of Atlanta. One was a 65 unit townhome complex. The other one was a 75 unit townhome complex. He was going to go and he had bought the land, brought it through what's called entitlement, which is the zoning and all the permits you got to get. And then he was a GC. So he did the horizontal construction of the pads and the lots. And he's also a builder. And he was wondering whether or not it'd be smarter to sell all of the units to one investor as a rentals rather than spending the next year and a half of his life selling them to retail investors, or I'm sorry, to retail homeowners, right? Mm-hmm. So I came and I said, hey, here's the cap rate. Here's what I think they'll rent for, and here's the cap rate that I think they'll throw off, and here's the price point I think you can get an investor interested in. He looked at his numbers and said, hey, this means I'm getting out of the project within 9 months as opposed to a year and a half or 2 years. That means I'm saving on disposition costs, I'm saving on financing costs, I'm saving on headache costs, and I can then go redeploy that capital into other projects that I have coming down the road, either for sale or for investment purposes. So in that respect, I made my money by showing the builder how we can fit this project that was for sale originally into the build for rent model and create a faster exit and create a more profitable exit for him at the end of the process. But by taking the very same units he would sell to homeowners and sell them to an investor. And I'm the guy that found the investor, and I negotiated the deal for him.
In my newest real estate investing book, The Flip System, you'll learn the proven secrets and strategies that I've used to be a successful real estate investor. You'll also hear the story of my journey from quitting my job to doing over 2,000 units of apartments. The Flip System is now available for a limited time, and you can grab your free copy at getflipsystem.com/podcast. You'll learn the same proven principles and secrets and investing strategies that I used to quit my job and pursue a life of financial freedom. In this book, I'm sharing exactly how I was able to personally close over 750 profitable real estate deals, make over 400 private lender loans, raise over $30 million, and acquire over 2,000 units of cash flowing apartments. Get my newest book now for free at getflipsystem.com/podcast. That's getflipsystem.com/podcast. So he did the development, the entitlements, the GC work, the building work, and sold the whole portfolio to a new investor that came in and bought it?
That's right. Yeah, he sold both subdivisions of about 120 units to one investor at CO. So he's building the units and he's delivering them in like tranches of 10 or 15 a month. And that's happening in sequence, right? So you think about, it's a crazy thing. And, builders had done it sporadically before, but never really in large scale like this. So you think about what I just said, there's money to be made from the land acquisition through the entitlement phase. So if you're a person that knows how to find land and develop land, you can find land, develop land, and then sell the entitled land. There's profit to be made there. If you're a person that knows how to take entitled land and put lots in the ground, so like actually do the site work and bring in the bulldozers, pull down the trees, do that. There's money to be made between the entitlement and the lots. If you're a builder that doesn't know how to do any kind of land work, you can always buy finished lots and then build homes and sell those for a profit. And then there's people that have expertise all along the spectrum that can add value by finding land, finding services for these different players, being a broker, being a consultant. It really, the thing about a new space like build for rent, there's not a lot of long-term expertise. So guys like me and others that understand the asset class of SFR intrinsically can add a lot of value to new capital that are coming in by sourcing opportunities and really doing the analysis and figuring out what the structure needs to be for capital flow into the space.
Yeah, Adam, I'm curious. It's fantastic. I love it. So as a former residential investor, I still have some in residential investments, but primarily value-add apartments. We're still trying to be in, whether it's resi or whether it's commercial apartments, we're still really trying to be in for about 70 cents on the dollar. Purchase and value-add improvements, capital improvements, CapEx, about 70% of the building's future value, so that we can either sell it or refinance it and return investors' equity principal. So does the build to rent community, are you operating on the same economics? Are you looking to be all in? So whoever is then selling the final portfolio, let's say it's 100, build to rent, total finished, there's a CO, it's delivered to an investor who buys the portfolio, all 100 units, and turns around and rents them all out. Is that guy trying to be all in at 70 cents on the dollar? Help me understand the economics. And are there certain areas where this is working better? Are there areas where, again, housing stock is limited? We know there's an undersupply of houses in general. because the reason why I really like this model and what you're talking about is the opportunity that you could sell each individual house as a retail property to somebody that moves into it and buys it. So you have these multiple exit strategies. So help me understand the economics of the all-in number and the areas where this is working well to kind of fill the need for both rental housing and potentially retail.
All right, you threw like 5 questions at me.
Yeah,
so I'm gonna answer
I'm good at that. I got like 8
questions.
questions for you. Throw them, just pick whichever one you want to answer and go from there.
So thinking about it from the perspective of the end buyer, the firm that's actually going to own the units and operate them over the long term, very hard for individuals or even high net worth individuals to play in that space. That's mostly institutional capital right now. And the way that's working is the cap rates that a institutional investment firm needs to achieve, depending on where they get their capital from. If you're talking about pure, like, I don't know if you know the term gross yield and cap rate. Gross yield is essentially gross annual income divided by the purchase price. Cap rate is net of expenses. People are looking for finished products in the cap rate range of 5.5% to 6% right now.
Wow.
And with the leverage that they're able to, the leverage that institutional investors are able to get, that means they can get an all-in return of like, low 12 to high teens, right? Buying at that kind of cap rate when you look at it on a levered basis. So I don't see that as a huge opportunity for the layperson, the non-institutional investor, to come in and really compete with the institutional capital just because their cost of capital is just so low. Their financing is just so good. I think the opportunity for individual investors or smaller investors to make money are in creating a product for those guys to be the takeout. And I've got a lot of clients that are doing that. So right now I'm working with a smallish investor. He's a wealthy guy, but he's by no means, $100 million fund. He's just a guy that found a 30 lot subdivision here in Charlotte. He spent 2 years going through entitlement, going through lot development, land development, and now he's building the homes. And he's going to make $1 million profit on these 30 homes by selling those 30 homes, not to residential homeowners, but to an investor. And the investor is more than happy to buy it from him at a very reasonable cap rate, because their numbers mean they're making money on a management fee, they're making money on a promote, they're making money on their side, buying at these low cap rates. My guy's making money because he has a know-how and the experience to find good deals and bring a lot of value through a development like that. So that's kind of how the dichotomy between like the end investor that owns the assets and the people that add value and sell assets to those kind of investors. If that makes sense.
Absolutely. So if somebody was going to develop a site of 20 or 50 build to rent with the intention of selling them to an institution, because you're in the space, are we looking for locating the institution and what the institution, like, do you begin with the end in mind? Meaning, do you try to locate the institution first that has an appetite to buy buy that community, find out what their buy criteria is, find out where they want to be, price per unit, cap rate, gross yield, etc., and then back in and go find them the site and build the houses in order to sell them? Or is it more spec where you're doing the building out the units, trying to then find the institution after you've broke ground or after you're starting the build? You've probably seen all the above, right? So help me understand what's the best way to do it.
Yeah. So you basically outlined the very reason why I started Strata SFR, right? Because what we do is we start with the end in mind. We surveyed dozens and dozens of investors, and we figure out what everyone's looking for and everyone's nuances and how they buy and what they buy and where they buy and the structure which they buy. That's the consulting and brokerage business and advice that we offer. If you're a person that's just out there looking for land and you don't have all day and the resources to spend on the phone with 2 or 3 institutions every day figuring out where they're buying now and how they're buying, if you're an individual and you want to start with the end in mind, you might talk to 1 or 2 funds that say we want to buy here, here, and here. And you would go find those assets and try to kind of fit those projects into that narrow scope. Part of the great thing I love about what I do is I can let builders and developers work on finding the best deals that they think are good deals because they know the market's better than anyone else. No matter what an institutional investor says that's new to a market or owns just several hundred, several thousand in an area, someone that has 20 years of experience or like years of experience buying and developing land and developing lots and developing and building homes, that person knows the nuances of a market better than anyone else. And what I love is telling a builder or a developer, you tell me where these guys should be buying, because they ask me all the time, where's the next coffee shop opening up, or where's the new library opening up, and where are the events, and where are the cars and coffee events going on? Where's the buzz around town? And as long as they adhere to a few simple kind of principles, where you can't be too rural, people don't want to buy out in the sticks. They need to be close to transportation, close to amenities like shopping and retail and restaurants, and it's got to have decent schools. There's like 20 check marks that an institution checks off when looking at a project. And if you keep that in mind when you're out there looking for good opportunities, coming to a firm like Strata or someone like me to say, hey, you tell me, out of all the investors that you work with, where's my project fit in best? And a guy like me says, great, tell me all about the project. I'd love it. It's going to fit these 3 funds. And I put it in front of those 3 funds and have them fight it out for it,
Got it.
And that's my model. So.
Got it. So knowing a guy like you who's got the access to the institution, which is then ultimately the end buyer that buys the whole complex, the whole portfolio, is a key part, because you might have a great development that you do, a great build to rent development, or even a development of single family rentals that you buy and rehab. They're all kind of in the same area, looking to sell the whole thing at one time. But if you don't have access into that end buyer, it could be tough to liquidate. So that's the need that's the area that you fill.
And I'm not saying that to find me particularly, that'd be pretty self-serving, but they got to have an entree onto the exit. You always got to start with the end in mind. And builders generally they're doing their business during the day. They don't have time, and they don't have the resources, or they don't want to understand what everyone wants. And at the end of the day, if you're a builder or developer and you just know a project is good because it has the right dirt and the right spot and the right schools and the right demographics, believe me, likely it's going to end up being a good build for rent project if the rents support a certain cap rate, which you got to know how to do, which guys like me can figure out for you.
Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast. Adam, what's the minimum size project that an institution typically would want to buy? How many doors or price are you looking at?
So if you asked me 12 months ago, I would have said between 125 and 175 being the sweet spot. And that's true for most institutions. But there's so many different kinds of players coming into the space of all different levels that right now I've done deals as small as 30 all the way up to my largest deal being about 220 units. So it really depends on, when you start with the end in mind, what your buyer's appetite is. And, I'm fortunate enough to work with a fairly large swath of buyers that range from high net worth individuals with family offices that like 30 or 40 or 50 unit subdivisions. But the real answer to that question has to do with the operation and the management, because as long as you can buy enough units to operate efficiently in a market, that's going to dictate how many units you ultimately want to buy. And if you're a large institution, that means owning 500 to 600 or even more in a market. If you're a small investor that is going to do the management himself, or maybe hire a third party but wants to do it on a smaller scale, maybe you're okay with 40 or 50. You're never going to get to 500, 600 and get the operating scale that most of the large institutions do. But depending on what your ultimate goals are, maybe you don't need that. So
got it. So Adam, so this is probably the last question. Then I want to ask you about some advice. Like, what kind of, after all the success you've had, what kind of advice would you give? But one question I have is, what's the rule of thumb? There's probably a rule of thumb that you operate. There's obviously, everybody has these spreadsheets, right? I've got them in my apartment business. Everyone's got them that they kind of can underwrite a deal off of. But there's always rules of thumb that says, okay, if an institution is going to want to be all in for X, and they're going to want to get gross rents of Y, and generally, let's say it's 10%, meaning if your price is $150,000, they want $1,500 a month. Is there a rule of thumb in your industry for that?
There is, yeah. So I'm not good at doing it off the cuff math. So Basically, for every $100,000, I mean, it's a little bit hard for me to answer that question depending on the market, but we're always trying to get to a cap rate or a gross yield of between, call it 8 and 10% of 8 and 10%. So gross yield, again, is gross income divided by purchase price. So in a market like Charlotte or a core market, Charlotte, Orlando, Jacksonville, Raleigh, top tier markets where inventory is at its all-time low, people are accepting gross yields for finished product as low as 8%, gross yields, which means they're accepting cap rates in the high or mid fours. So if you do the math, and depending on where you're looking to sell the deal out, if it's at completion of the units, you want to target, closer to an 8.5% gross yield. If you're selling lots and expecting someone to build a home on the lots, you're targeting a tick higher, a 9.5, 9.75. If you're looking to sell entitled land, if you figure out what the ultimate gross yield is going to be when a unit is on there, you want to be closer to 10, 10.5. So I don't know what those exact rents versus prices are, but the good rule of thumb is if you figure out what the ultimate rent's going to be per year and divide it by the price you think you could sell it for, you want to be in that 8 to 10% gross yield range.
Perfect. Got it. So Adam, now that you've been in this industry for a while and you've sold more single family rentals than anybody, what kind of advice would you give your younger former self or some of our audience about some things you've learned along the way? Could be business advice specific to the SFR industry or just entrepreneurship advice. What do you think are some of the keys to your success and some things you'd like to pass back to our audience?
So a friend of mine, when I first started in being a sales guy, when I was like 21 years old, he said something to me, like it always stuck with me. And the more older I get, it resonates even more. Don't get too high with the highs or low with the lows. If you're in real estate or any business that you depend on a commission or a sale or a profit to happen, you are inevitably going to have moments of absolute euphoria and you're going to have moments of dire straits. And the more I recognize when I'm in those moments of euphoria to ultimate despair, I realize if I could stay here mentally, if I keep, my family life and my spiritual life and my work life all in balance, my financial life, I realize that when things are going really good, I got to remind myself things are going to get bad eventually. And when things are bad, I got to remind myself things are going to get really good eventually. So trying to keep that even keel, that's the advice I give to my younger self. Stay even keel as much as you can.
So Adam, your website is stratasfr.com. You guys look them up on the internet. Whether you want to play anywhere along that spectrum, even being an active investor, passive investor, developer, or learn more about how you can play, Adam's the guy that we would recommend to lean on for advice. And if you have a portfolio that you're looking to exit, Adam may even be able to find you a buyer. So Adam, listen, thank you so much for joining us today on Accelerated Investor.
It was awesome talking to you. Thanks so much. I had a lot of fun. Thanks a lot. Appreciate it.
Hey, Josh here. And do you want to win a free Accelerated Investor t-shirt? All you have to do is give Accelerated Investor, our podcast, Accelerated Investor, a rating and a review on iTunes. Okay? Do that now. Then send us a screenshot on Facebook or Instagram or Twitter. What we're going to do then is every week we're going to pick our favorite rating and review, and we're going to send that person a free t-shirt and maybe, again, some other cool, fun stuff as well from Accelerated Investors. So, again, don't forget to take a screenshot. Leave a rating, review, take a screenshot, send it to us so we know exactly who you are. And then once a week, every week on the podcast, we will announce a new winner. Don't forget to take a screenshot and send it to us so we know exactly who you are. We'll announce a new winner every week.
You were just listening to the Accelerated Investor Podcast with Josh Cantwell. If you enjoyed this episode and learned something new, help us build the AI community by leaving a review and 5-star rating on our iTunes podcast channel. Also, don't forget to subscribe so you never miss another episode. To see passive investing opportunities, visit freelandventures.com/passive. To start your journey toward the lifestyle you've always dreamed of with multifamily apartments, apply for one-on-one coaching with Josh at www.joshcantwellcoaching.com.